Good evening and welcome to the FITT Show, which stands for Financial Information for Today and Tomorrow. I'm Bobby P. Kinzer, and that's Thomas Doty. And we are the creators of the FITT Show. And we came up with this idea because we want to be able to provide information for our people to be able to understand how to plan, manage, and come up with ways that they can create wealth. So welcome. We're here every Thursday at 8 p.m. How you doing today, Dope?
I couldn't be better. Happy to be alive.
Oh, man, yes. It's so much better to be seen than viewed. I ain't lying. So today, Dope, we got a real interesting show. A lot of people have been asking about this, and I'm looking so into this particular show. So let's get things started. Dope, what do you consider the perfect personal investment portfolio?
It's a tough question to answer because there is no perfect portfolio for any particular person. It depends on where you are in life, how much you have to invest, what's your risk tolerance, your age, what are your goals. And the important thing about it comes down to what's important for you or what's the best portfolio for you at that particular point in time. And for most people, that's going to change over time. But the basic premise is you don't want to be 100% invested in anything. It's the old adage, you don't want to have all your eggs in one basket.
And it's interesting you say that, Dope, because a lot of people, or most people, think that investing in the stock market is only for their retirement. So they start with like their 401k plan or their employee-sponsored plan. But after they've maxed it out, which you can put $19,500, that's the most you can put in a 401k plan or 403b plan, then what? What about the rest of your money? You know, it might be sitting in a checking account or a savings account, and instead of growing in the stock market. So the allocation of your assets is very important. And another important thing in managing your portfolio is going to be your risk tolerance, your time horizon, and your cash flow needs. And these are the kind of things that we're going to be talking about today, all the components involved in managing your portfolio. So with that, Dope, what does managing your portfolio really mean?
Yeah, it comes down to diversification, how you diversify your investments. As Bob just talked about, you need to look at your whole portfolio, everything you own, so you can understand where you are, what segments you're invested in. And the goal of diversification is to mitigate losses in one particular segment of your portfolio and maximize your growth potential. That's pretty much what you're trying to do. Again, you don't want to have everything in one basket. You want to have something that's going up if times are good in that particular segment. At the same time, you have something that if that particular segment is going the other way, you have something typically runs counter to that, and that will do okay too. So it's like managing the components of your portfolio as opposed to picking an individual stock. And that's a huge thing you should understand the difference between. This is managing your total portfolio, whether it's stock, funds, or whatever you have.
It's more geared towards your to also taking advantage of the fluctuations in the stock market.
That's for sure. Because it's just like sometimes things go up where other things go down. And if you have a diverse portfolio, you can take advantage of that. And you always have something that's doing well. Okay, that's the key. You want to always have something that's doing okay, no matter what the market is doing at that particular time. Again, this is not a get-rich-quick scheme. That's not what we're trying to push across or help you or make you understand. This is a steady way to grow wealth over time through investing in mutual funds, equities, bonds, stock, real estate, and other investments.
And it's so important, diversification. Diversification is cool, it's important. Like you say, it's not putting all your assets, all your apples, eggs in one basket, but it's also about asset allocation. And a lot of people don't understand the difference between diversification and asset allocation. The diversification is the management of all the different assets that you can, like real estate, it could be stocks, bonds, but asset allocation is within a particular asset type, because it could be, equity with growth funds, and it could be in growth in income. It could be just bonds, income funds. So those are things we're going to get into. So, Dode, I want to start off by talking about one of the first main things in maintaining or managing a portfolio, and that is determining your risk tolerance. Now, we've said this many times on the show. I know you've heard this, because risk tolerance is important, because that defines and determines the type of investment products you could be in. Because as we always talk about investment products, they all have different risks. There's low risk, there's high risk. There's low risk, we know low risk, the lower the risk, the lower the return. High risk, the higher the risk, the higher the return. But with that comes a certain temperament, so that you can be able to sleep at night. And then the other important thing is understanding and knowing how much you can afford to risk. And that's always important, because whenever we talk about investing in the stock market, remember this. We may not say it every time, but this is what we're saying when we tell you to invest in the market. It's not about putting in money that you're going to need for the short term, or putting money that you may need to pay your mortgage or your child's education. It's all about putting in the amount of money that you can afford to risk. So what about goals, though?
Yeah, that's the first thing. And we've talked about this before, but when you talk about managing your portfolio, it becomes even more important. It's your expectations for a particular investment. What do you expect it to do? What's your time horizon? And what is your particular goal for that? Is it long-term growth? Is it short-term profit? Is it something that's conservative? Is it something that works well if there's times of inflation? Is it something that recession-proof? All those things go into establishing your goals. But that's always where you start. What are you trying to do? And then that's going to help you determine how to come up with your asset portfolio.
And that's important. So it's risk tolerance, your goals, and you need to understand your time horizons. What particular time are you going to be needing the money, or you want your money to grow at a specific time, specific level. And one of the things we talked about before is the rule of 72 that helps you determine those kind of things. So don't forget the rule of 72. When you just divide whatever return you want into 72, and it gives you the amount of years that it will take it for your money to double. Those kind of things are very important to understand. Though I want to talk about a little bit about the different, understanding the different segments within the stock market itself. Now, as we know, there's the U.S. markets and there's international markets, and that's the wonderful thing about having choices like that. The U.S. markets obviously are companies that are United States based, and then you got obviously companies that are in Europe, companies that are in Asia. But the difference is when you start going from United States to international markets, you got to understand that there's different policies and rules and requirements determining which market that you're investing in, especially when we start talking about, being based in America as opposed to being globally based, because those kinds of things can affect the stocks that you're investing in. But it's very important to understand that there's different segments that you can invest in. That's the beauty about the market. Then we have, well, right quick though, I know a lot of people hear about the New York Stock Exchange, and then you hear about the NASDAQ. And then a lot of people wonder, then you hear about the Standard & Poor's 500. And then there's the Russell 2000. All of these are different exchange markets where you can go and invest and purchase stocks and bonds and securities under. but each one has a different component. Like the New York Stock Exchange, they started like in the 1800s, right? And they have now about 2,800 stocks. And it started off that the New York Stock Exchange had the biggest corporations, and then the NASDAQ was really starting with the small company. But now the NASDAQ has caught up. They got 3,400 stocks, and normally a lot of the tech companies put their stocks on the NASDAQ. But we come to large cap and small cap, and I know you all out there have heard that, like, what in the world is large cap versus small cap? Well, large cap is just plain and simple. It's a large cap is usually large, well-established companies, and the volume of trading is usually $10 billion or more. So they really large, well-established company. And small caps are usually emerging companies, and their volume is somewhere anywhere from $2 billion and less, because they're small companies, they're emerging. And we know if they're small and emerging companies, they usually have high risk, because what? They're just starting. They're new companies. They're just coming on to the market, right? So then you got everything in between, because there's mid caps and there's everything that's in between. The mid caps are somewhere around, I think, about $5 billion and lower. But that's why you need to understand the capitalizations of the companies that are in there, because that tells you the size, how well they're established. It doesn't tell you everything about them, but it gives you some information that you can understand about them. Then you have the different market sectors. And when we talk about different market sectors, and let me give this caveat, you all. Tonight we're going through a lot of information. A lot of it you're going to probably have your head spinning. But we need to talk about these things so that you can understand the basic components of being able to manage your money, because you just don't want to totally just rely on a financial advisor or a stockbroker. You need to understand your own money. You don't have to have a degree in finance. You don't have to have an MBA. You don't even have to be a financial advisor to be able to understand the basis of your money. And that's why we're going over some of these things, because some people are like, Bob, you give me a headache with all of that. It's going over here. No, we're not telling you got to be a specialist in this information, but you got to understand some of the basics. So when someone come to you, you can determine and understand what they're going to do with your money. So I want to continue. Just want to give that sidebar note, because a lot of people, want to tap out. They're like, oh, geez, you give me a headache, Bob. I'm like, hold up. So market sectors, those are like technology stocks or technology fund. They have all tech funds in it, like Microsoft, Google, Facebook. Then you got healthcare, you got utilities, communication, and transportation. And transportation could be autos like Ford, GM, or transportation, it could be stocks that are deal with investment in fixing the roads and building bridges for transportation, or railroad. So it's so many different sectors you are. And what we're trying to just express to you is that it's a whole gambit that you can invest in. And one of the keys is just, being able to understand and pick one or the other. They'll talk a little bit about choosing equities versus managed portfolio, because people think there's a difference.
You say when you talk about you put the other items other than equities?
No, I'm talking about first, most people should have about 40 to 80% of the portfolio invested in equities.
Right.
So you're not talking about just picking stocks. We talk about now the management of the stocks. That's what I'm talking about.
Yeah, and we're on the same page, even though we might be a little different on where we stand in the spectrum. But we feel that personally, between 40 and 80% of your investments should be in equities. The higher numbers, obviously, is a little more risky. The lower numbers, a little more conservative. I think Bob's closer to the 50% area. I'm
Yes.
closer to the 75, 80%, because I'm more of a risk taker. But that's kind of your base for where you want to start with a good portfolio. And so you look at how you invest in those stocks. And that's why Bob is trying to help you understand all the different market segments you could possibly invest in, which is difficult to understand and comprehend. It's a lot to learn. But as he said, you have to know this stuff, or at least be able to discuss it intelligently. So if someone comes to you with a proposal or a suggestion or recommendation, you can make sense out of it. And if it doesn't make sense to you, you should never invest in something that does not make sense to you. Don't let anybody put your money in something that you don't understand. That's a recipe, definitely a recipe for failure. So that's kind of where we feel your base should be, is somewhere between 40% and 80% in equities. And then we'll fill in the rest around it with some of the other things that we'll talk about in a minute.
So what I want to add to that is, you also want to be able just to know the question to ask. Mm-hmm. That's the other thing with getting information. It's not just you being able to answer the question. It's also so that you can be able to ask a pertinent question too. And that's how this information helps. And
right.
They'll talk about the other options. Some of
those other things you can fill in around the equity investment would be things like real estate. It could be a real estate trust or a real estate fund, precious metals. It could be cash and cash equivalents, money market accounts. It could be bonds, and bonds run the whole gamut from extremely conservative and extremely no risk when you talk about government bonds, all the way to junk bonds, which are extremely risky, but at the same time, they offer an opportunity for a higher return. And so you also have cryptocurrency, which at this point is extremely volatile. And I personally only put a little bit of my money in that because it's that old thing. I don't want to be left out and let everybody else make a whole lot of money and I miss it. But I would never put a lot of money in something like that. But those are the things you fill up around your stocks and equities. For example, gold. You might be in precious metals. Gold as a hedge against inflation, because in inflationary times, gold typically does well. So those are the other things you want to fill in around your stock base. And those are some of the other things you want to invest in.
And we talked about these different market segments and sectors, you all, and it sounds like a whole lot, and it is. And you may ask the question, well, Dope Bob, which sector should I invest in? Which segment should I invest in? Well, the name of the game is any one of them are just as good, but you need to do research. And we're going to have another show that we're going to talk on how to pick stocks. But the main thing is, and we talked about this before, though, one of the things that help you know what to invest in, if you brush your teeth every day with Colgate toothpaste and you comb your hair with, Ultra Sheen, then why not purchase those products that you're using and other people are using? That sometimes help you determine what to invest in. Or if you know and you see that certain markets are doing well, let me give you another example. Dope, give them an example. And we're not saying this is what to do, you all. We're just saying, I know we're telling you all these segments and stuff, but this is how you sometimes can determine to get into some of them. Don't tell them about Peloton.
Yeah, that's a stock that I've been watching for a while. And everybody I know has a doggone Peloton. And so I figured it was going to be a good stock, but I kind of missed the initial run-up. So it was about maybe 3-4 weeks ago, they were having a lawsuit because their treadmill was injuring people. I think it may have actually killed 3 kids. And at first they kind of denied any fault, but then they came out and admitted it was their mistake. And their stock took a big hit. It was at 92 and it dropped to 82 in one day. So I saw that big drop. And again, this was 3-4 weeks ago. So I decided to buy 100 shares of Peloton. And just because, again, everybody I know has one. That seems like the thing right now, especially with everybody being at home. And so in that 3 or 4 week time frame, it's gone from like 82, I think the last time I looked, it was 119. So it's going up over 30 points in that time. And again, that's kind of a hunch that I play, and I'm not recommending that for anybody else, but I just saw that as an opportunity to get involved in a stock that I think is going to continue to do really, really well, because I'm sure everybody knows somebody who has a Peloton, and I've never heard anybody who have a Peloton say they don't like it. And they may not like it, but they're not going to admit spending that much money they're not liking it. So everybody has one. A lot of people use them. It's a great tool, and it's a great stock to buy.
So once again, disclaimer, we're not telling you to buy Peloton. We'll never tell you the exact which stocks to purchase, because we're not certified or registered stockbrokers, but we're just giving you an idea of how you can sort of look and think about some of the segments to invest in.
Hey Bob, and short of picking a stock, if all else, if you don't want to get involved with that, there's nothing wrong with just picking a broad-based mutual fund or EFT and saying, I just want to invest in the market. I'll invest in a fund that mirrors the S&P 500. So as the market goes, my investments will grow. There's nothing wrong with that, because you have the benefit of being invested in the total market. And so your risk is mitigated because you are invested in pretty much everything. Now, obviously your return won't be as good as a particular segment might do, but you'll do what the market does. If the market goes up 20%, your investments that you have invested in the S&P 500 will go up, should correlate to what the market is doing. And that's the way to do it when you don't really want to get involved in picking stocks, or you don't have enough knowledge to pick stocks, or you just want to be invested in the market and kind of put the money there and forget about it.
And that's the thing about index funds. We're talking about the Standard & Poor's 500, or mutual funds or ETFs, exchange traded funds, would operates like mutual funds. It goes back to what we talked about before, not putting all your eggs in one basket. It has several different stocks. So if one is going up and the other company's doing bad, it mitigates the risk. If one company that was doing bad is now doing good, then they move in and manage that money there. That's the importance of understanding index funds. But we want to close out on talking about understanding the segments and the sectors, dope. And I know people know this, but these are things that can affect, any market. And that's politics, economic factors determines a lot of what happens to the markets. And that's why we want you to diversify your portfolio. Elections, natural disasters, growth, domestic products, meaning inflation and the purchase of products and of goods going up or going down, unemployment, and even terrorist acts can affect. And this all leads us to why it's important to diversify your portfolio. And that's what you want to know. So let's get into investment strategies like activity ranges and things like that. What does that mean?
It's what you intend on, how long you intend on having the money. For example, one strategy might be buy and hold. And that's, I'm going to buy a stock. I'm not going to worry about what the little ups and downs. I'm going to hold it for the long term and just let it play out. And typically, those are big blue chip stocks that you put the money in and you kind of want to forget about it, and you expect that to do well over the long haul. And a lot of times, obviously, you want to pick something that's not as risky if you're looking for a conservative play. Or you can have a stock where instead of buy and hold, you pick a target price. You say, okay, I buy this stock at 100. If it gets to 120, I'm going to sell. You set a target price. You can actually go in to most brokerage apps, and you can say, when it hits 120, automatically sell it. So you set a target. When it gets to that point, you automatically sell it. You can also set up a loss limit. You can say, I bought this stock at 100. If it goes down to 90, I want to sell it. So you set up guidelines, both high and low, to say this is where I expect this stock to play. Now that's more of a shorter term play, as opposed to when you buy and hold and you're not going to worry about the little fluctuations in the market. And you just say, okay, this is a 3 to 5 year. I'm not going to worry about it. I'm putting it in and forget about it. And that's when you talk about activity ranges, buy and hold, setting target prices. Those are things you do when you decide how long you're going to be in a stock and what you expect from that stock.
And both me and Dope are sort of with the philosophy of, and I think this is the best way to invest in the stock market, and it's with the long-term approach, not just jumping in and out. Because in order to jump in and out, you got to really understand what you're doing, because for one, you're going to be creating taxes, and you got to be able, because I know a lot of people are talking about day trading now and stuff like that, and you got to really know what you're doing if you're jumping in and out on the short term. But we usually on the long-term play. Leave the money. And that brings me to this, though, which you just talked about, buy and hold. Reason why we believe in buy and hold, because investors, a lot of people, there's a myth that people think investors need to constantly check their investments. No, you don't. You can at best check it quarterly, or 6 months, or yearly. But you don't have to be watching it every day. That's the worst thing you can do, actually. Right, though? Looking at it every day. So that's why you diversify and leave it there. And especially if you get into like an index fund or something like that, a mutual fund, if it's a good one, you can just leave it there and not even look at it till 10 years later. You know what I mean? I don't suggest that to everybody, but that's how I tell some people, because if the market, though, what you always say, over time, it performs and it gives you a return. Right. Over time. But if you jump in and out, you can get beat up trying to time the market. So you don't have to constantly be checking on your investments if you have the right asset mix.
Right. And you've made a sound decision going in. Yeah, checking every day is not the way to do it, because one, you're not going to do anything if it goes down or go up, if it's a long-term play. And so all you're doing is aggravating yourself. But it is nice, as Bob said, you take a look quarterly, maybe even monthly. When you get your statement, you take a look at it, see how it's done, make sure it's doing what you expect it to do. There's going to be fluctuations in the market. The market dropped almost 800 points Monday, and it was purely because of the COVID scare, that COVID is getting worse. But then the next 3 days, Tuesday, Wednesday, Thursday, it's more than offset that loss, and it's back above where it was when it dropped to 800 points. So you don't want to get involved in the buying and selling, because one, you're not that good, because the people who do this for a living aren't that good. And so you want to invest in something good, leave it in there for the long haul. And as Bob mentioned, even at the tax implications, if you sell within 1 year, it's ordinary income, as opposed to if you hold it over a year, it's a capital gain, in which case you may only pay a top rate of 20% in taxes. So there's definitely advantages to investing long-term, letting it sit, not sweating over it, and realize over time you're going to be okay.
And that's why, depending on what segment or sector you're in, it's all risk. And all we're just saying is trying to give you information on how to try to mitigate your risks, and managing your portfolio is almost like leveraging. You want to have some high, you want to have some low, and you want to have some equities. You might want to have some cash equivalents, and we're going to talk about that further. I want to remind everyone, please click on the thumbs up button, the like button, because that gives us traction out there to reach more people. And put a comment in there. Let us know. Let us know some things. Like my man Clutch is out there. He said people need to do their research. That's so right, brother Clutch. And we want to say hello to Niall, even though we know you out of town, but you're tuning in. I love it. So click on the button, click on the smiley face, y'all, and you can't click it enough times, you all, because that helps us tremendously. We're at this hour, but we actually got enough time to do the rest, because we're going to think about cutting. But we're going to get into the second topic question, though, which we definitely have time to talk about, and that's how do you diversify?
Okay,
The whole key to this whole conversation.
And as we said before, you want to start with a mix of equities. It could be a balanced index fund. It could be several stocks, but that's your starting point, a solid base of equities, be it an S&P fund or an EFT. And then you fill it up around that with maybe some bonds, some cash equivalents, and things of that sort to offset potential down or drops in the market. So you want to have something else to offset that. You may put 5% in a real estate trust because real estate's pretty consistent. You may want to put 5% in some sort of precious metals as a hedge against investments. But you want to have a base in equities and you fill in around it with some other investments. You don't want to be 100% in stocks.
So, Doe, with that, let's look at this chart here. Do you see that, Doe?
Yep, it's there.
Why don't you explain that to the people?
Okay, this is when we talked about determining what your risk level is. And this is saying, and again, these are just guidelines. As I said at the beginning of the show, there's no perfect portfolio. It all depends on a bunch of different factors, how old you are, what you're trying to do, and these are just averages, let's just say. So for a younger person, we recommend you be around 70% in equities, and you may have 5% in cash equivalent and the rest in bonds. But the point that we want to make is you want to be more heavily invested in stock because there's a high reward. You're younger, so you have time to recover if there is a drop in the market. And over time, you're going to do okay. Medium risk, near retirement, you want to obviously lower that equity amount and maybe put a little bit more in bonds, obviously conservative bonds or more not risky bonds, in other words. But you definitely want to lower your investment in equities. Now, for a low risk retired, and this is something Bob and I disagree on because it used to be that they would say, as you get close to retirement, you have less and less in stocks. But as we talked about before, the life expectancy has increasing. So if you start at 65, and let's say your life expectancy is you expect to live to 85, you got 20 more years to live. And the one thing about being retired is you never get a raise the rest of your life. You get the little COLA increases from Social Security, but you don't get any increases in your pension or your Social Security. So you should be less invested in equities, but I personally believe you should still be invested in equities, not to the extent of only having 22% in stocks. Me personally, I'd be more toward the 40% almost up to 50% in stock because you have to find a way to beat inflation because that's one thing that's going to be constant. And if you're not at least keeping pace with inflation, your buying power will be decreasing. So you'll be losing money. And if you expect to live, once you're 65, and you expect to live another 20 years, again, that's ample time to recover from any drops in the market.
And Doe, it's not just keeping pace with inflation, it's also keeping pace with taxes because you got to pay taxes too on that money.
Yeah. Oh,
so
yeah.
So for instance, if you have an investment that's giving you a 10% return and inflation as of today is at 5%, that cuts your return to 5%. And now if you're paying taxes and then you're in a 25%, 24% tax bracket, that's a fourth. So you take a fourth off of there, your return is really giving you about maybe 4.5%, 4% or 3.5% is what your real 10% return is. So another rule that they used to have, old rule is to determine how much your allocation mix should be is they said take 100 and subtract your age, and that's how much you should be in equities. So now, because of what you were saying, Dope, the life expectancy, they're saying as you get older, you can take a little bit more risk, because this chart here is based on the old fact that as you get older, you should be less riskier and less in equities and more in mid-range bonds, meaning municipal bonds and government bonds. That's what these bonds they're talking about. But they say now take 110 and subtract your age, and that should tell you what you should give you an idea on equities. But once again, that's just what that little model is actually saying.
Yeah, and again, those are just ballparks. Those are just estimates, and to help you determine where you are. And so when you sit down and talk to your financial advisor, you have an idea of you should have an idea of where you want to be. A lot of times they'll ask you on a scale of 1 to 10, what's your risk tolerance? And with 10 being I want all the risk I can get, and 1 being I don't want any risk at all. And like I always use 7. 7 is my number. I'm not all the way crazy risky, but I do want to absorb some risk because I want the return that goes along with that. And so my advisor, he kind of looked at me like, you sure you want to be at 7? And I'm like, I definitely want to be at 7 because the money I have invested with him, I don't anticipate needing in the foreseeable future. You know, I'd like that money to grow at a high rate and hopefully one day leave a nest egg for the kids, even though I always tell them I'm not. I always tell them I'm going to be on my deathbed ordering non-refundable stuff from Amazon. But I think they know that's not true. But that's why I'm willing to take a little more risk.
So the other thing, though, we need to talk about before we close out is sticking to your plan. You need to make sound financial decisions, and you need to and don't make emotional decisions.
Yeah, and you got to review and adjust, and that's very, very important because once you have a reasonable portfolio, what oftentimes happens is one part of your portfolio may perform at a much higher rate than the other parts of your portfolio. So let's just say you've decided you want to be 60% equities, 30% bonds, 10% cash. And that's kind of a moderately aggressive portfolio. But let's say you're in the middle of a bull market and your equities perform much, much better, and they might become 75 to 80% of your portfolio. So that's where when you review, you need to dial that back, take some of the earnings on the equity to get back to your comfort zone of 60, 30, 10. That's the significance of reviewing, because you don't want one part to get too big and it takes you out of where you expect to be in regards to your risk tolerance.
Hey, there's a comment out there that says, Clutch said he was reading where the COVID dropped the life expectancy by 1.5 years. I can see that.
Oh, yeah.
I can see that.
That's
and Clutch,
sure.
give me a clarification what you mean, can a portfolio will be attacked for any reason? Help us understand what you're asking us there. So let's take this home, though. We definitely made it within our time frame. Let's give the summary and some of the takeaways. My first takeaway, though, is make sure your portfolio reflects your goals. That's what we talked about earlier. You can't do that enough.
Yeah, remember to review and adjust to stay within the constraints of your risk tolerance.
And you must make sure your portfolio is diversified. That's the whole thing with managing your portfolio is about. Understand your asset allocation.
Right, and try to get an understanding of those market segments and determine where you need to be to optimize your chance for growth.
And the last thing, though, but not the least, don't put all your eggs in one basket. That's what this all is about. There's no silver bullet in understanding the stock market. When I was a stockbroker, we had a class, and they took 4 of the top financial managers in the United States, and they took 4 monkeys. And they just had the monkeys, they put the Wall Street Journal in front of them, and they just pointed. The monkeys outperformed the professional investors. So there's no rocket scientist or silver bullet way to get rich quick. But one of the keys in understanding you all to create wealth, to grow your assets, is being able to manage your portfolio where it doesn't matter if there's an election and if there's a Democrat or Republican in. It doesn't matter if it's a pandemic. It doesn't matter if it's a tsunami. If you make sure you manage your portfolio properly, you can withstand any future shocks from the economy. And that's what this whole show is about, and trying to get you to understand managing your portfolio as opposed to what to pick in the portfolio. And we're going to have a separate show on that. But we want to talk about the macro. Managing your portfolio is so important.
Right. And to Bob's point about the monkey and the professional stock pickers, the important thing is that you are invested. That's another takeaway. You do want to be invested. You can't make money if you're not invested. If you don't have a plan, a budget, you got to put money in there to make money.
And remember the other takeaway that I mentioned up top, you know, it's not just about having all your money in your retirement plan, your 401k plan, right? Because you could only max out with that. So what about the other money that you have sitting in a checking account or savings account? And it's not earning when it could be in the market growing. Because remember, the key and why you need to be in the market is because you want to keep pace with inflation and taxes. If you outpace that, you will be able to create wealth. And it's counterintuitive if you think savings is going to build wealth. Savings does not build wealth. Savings accounts are paying less than 1%. You have to be able to purchase and get into appreciating assets. That's how you grow wealth. With that, Dope, you have any closing remarks?
Nope, I think we've covered what we want to cover.
We covered everything. It was a lot. Once again, y'all, we had 20 pounds of information in a 10-pound bag. If you have any questions, you can still go out there and put questions in the comment box, because I know y'all do, because nobody expert in this. Remember, you all, money is constantly working and moving. Even when you sleep, money is doing things. And the more you understand about money, and this is anything you get from us, you want to control your money. You don't want your money to control you. You don't work for your money. You want your money to work for you. Though we've had a lot of people tuning in, coming in and out. We thank you so much. Oh, we got Teresa Doty out there. She said, feeling more fit. I love it. All right, you all. Have a wonderful evening. Tune in next week, 8 p.m., The FITT Show. Financial information for today and tomorrow. Me, Robert P. Kinzer, and Thomas Doty, thank you.